we have any reason to be optimistic that this moves the ball on Monday?
Well, I think everybody's happy that the movement of the ball is forward, even though it's really very small. It was unclear to almost everybody as to exactly what Chinese actions the president was objecting to. That is why he decided to threaten the Chinese again over the past couple of weeks. Whatever it was, it looks like it has been resolved. The Chinese do have export controls on certain critical minerals, and it has been taking time to get approvals for those exports to be made to the United States, which is what the Chinese agreed to the last time the two delegations met. But we don't know what will happen in London on Monday. There's a lot that we don't know about what the U.S. is actually asking from China. The really big tariffs have been removed, but there's still 30% plus, of course, the whole first trade war tariffs.
Mm-hmm. Well, that's certainly true. And as you mentioned, export controls that China has in place. The U.S., of course, has export controls of its own that have actually expanded since the détente was reached in Geneva. Mary, how much more complicated does that make joining one another at the negotiating table, where even when you're putting tariffs aside, there are still other areas in which the U.S. is actively trying to restrain China?
Yeah, Kailey, you brought this up before, and it's very important to keep this in mind. The U.S. has been using export controls on the transfer of technology to China since the first Trump administration, really ramped up during the Biden administration. And now, again, we're seeing further ramping up, most recently with the U.S. restricting Chinese access to the software that designs the advanced semiconductor chips that are at the heart of our export controls. But they've been doing other things. They've been adding firms to the entity list. And I think something that China particularly objects to, which is that they've been strong-arming governments to remove China from their supply chains as part of their negotiations with other countries that are trying to also get out from under of the so-called reciprocal tariffs that the president announced on so-called Liberation Day. So there's a lot still going on that looks a lot like decoupling progress. Whether we can get these really, I think, quite destructive tariff rates down permanently so that firms can begin to make plans, that's what we're really trying to keep our eye on.
Mary, the administration says China needs us more than we need China, economically speaking. Is that true?
Well, this is a dance. We both have our roles to play. Secretary Lettinen said they need our money. We actually need their money. We have a lot of treasury bonds that we're going to want to sell, and we need the rest of the world to buy them. So I think we have a lot of dependencies. We are seeing it in critical minerals. We are nowhere prepared for an out-and-out trade war with China again. That is something that has been happening gradually since the first trade war. The share of U.S. imports from China is down. Nevertheless, we're still seeing a lot of Chinese content in our imports. China, of course, is diversified away from the U.S. quite substantially. And on that, I think that China needs us less than we need them. Nevertheless, it's still important to both sides. We're seeing that by their willingness to come to the table in London despite this recent spat.
Mary, I'm sure you just heard our brief conversation with Michael McKee about the labor market data we saw today, seeing a gradual softening in this economy. If we do not see an outright resolution in this trade issue between the U.S. and China by the end of the 90-day period in which we are in now, how quickly could the impact of those tariffs that could go back into place feed through into the economic data and the labor market specifically as companies have to grapple with that?
Yeah, we are going to see an impact, even if it is so-called resolved, because there is really no world in which we think that there won't be tariffs on most of our trading partners, perhaps at 10%, with higher tariffs on most Chinese goods, because, again, they're still subject to the first trade war tariffs and maybe perhaps some new ones. So there's going to be tariff damage to the economy either way. If, however, these talks go badly and tariffs are ratcheted up to the levels that we saw, really eye-popping levels of 145%, that would be very damaging. We're already seeing softening in consumer expectations. Purchasing managers index suggesting that manufacturing activity is slowing down. A lot of investment is being done in the U.S., but a lot of it is data centers. That doesn't create a lot of jobs, except in construction usually. So there's still a lot of things that are weighing on the U.S. economy. We're still seeing port numbers that will shrink. We've been benefiting from an increase, sort of a forerunning, getting ahead of the tariffs. That's led to lots of jobs in wholesale trade. So these are all going to go away.